to our attention probably three pieces of business news which are relevant, to us. The first relates to, the debt ceiling in America. For those of you who've been reading business news, finance news, you would know that, public debt, when I talk about public debt, I'm talking about the amount that governments are borrowing, is skyrocketed in the modern era. And America is a very good example of a government that is keeping on borrowing and borrowing. And in the last 2 weeks, there's been quite a lot of noise in the news about the lifting of the debt ceiling. So what happens in America is that legally, the government cannot borrow beyond a certain level. They would have to go to Congress, which is the equivalent of their parliament, to have that debt ceiling, lifted. We know that the government debt in America is something like, 31, if I'm not mistaken, 31.45 trillion, dollars. America keeps on borrowing and borrowing and borrowing. It's still a AAA economy, but what is worrying me is that there is no way that they can continue borrowing, at that rate. In fact, I'm firmly of the view that sometime in the future, we don't know when, there is a possibility that America may actually default on its debt. I was listening to some bankers in the past, few weeks, and they were even modeling a scenario where America defaults, on its debt. And what is actually interesting to me is that most of that debt that America holds is, investments by, China, for example. So China holds a significant portion of US treasuries, which is the public debt that America, has actually issued. The second piece of news that I would want to bring to our attention, again on the theme of debt, I was in Zambia, the past few weeks, and I was talking to bankers there. Everyone has been worried about, the restructuring of the debt in Zambia, because it came to a point where the government has borrowed, quite a lot of money. And one of those significant, creditors, so Zambia has got about, 6.6 billion US dollars in debt. And about 35% of that debt is actually held by the Chinese. Interestingly. And so they are going through a restructuring of, of their debt. The other thing that I would want to bring to the attention of our audience is the fact that the South African Reserve Bank raised interest rates, in the last week by 200 basis points, which was, I think to my mind, the 9th consecutive raising of interest rates. So the cost of debt is becoming, more and more, although from what they indicated and what other central bankers have indicated, we are coming to the end of that interest rate, hiking cycle. The other piece of news that we've been, reading about, which I would want to reference, is of the tensions that are beginning to develop between America and China. You might have picked that there was a balloon which was actually shot down in America. The Chinese maintained that it was a weather balloon which had wandered into American, territory. And, the Americans are still maintaining that it was a spy balloon. Why am I raising all of these issues? I think these are the themes that are going to constitute what we'll be talking about in the future as far as investments are concerned. Number one, the level of borrowing by governments. I think that's a huge, area of concern, particularly by the American, government. At some point, they're going to default. The second thing is the geopolitical risk, the geopolitical tensions that are going to be a source of uncertainty in the way that asset prices will respond to everything that will be, happening. And I'm not quite sure that some of the asset prices that we are seeing on the stock market are essentially pricing for that geopolitical, risk. I think geopolitical tensions are going to be a theme, going forward. And even when we build our investments portfolio, we need to be watching out, particularly for tensions between countries. That will be an investment theme going forward, which potentially can even affect stock market, prices. And then another theme is the uncertainty in the environment. At a personal level, we've always dispensed this advice, and this is the advice that we have dispensed. It's not time to be borrowing money. It's not time to be borrowing money, at all. If you are highly indebted, come up with a plan to get rid of, the debt. Yes, interest rates are rising, but the interest rate hiking cycle is coming to an end. But my view is that there is always that remote possibility that the financial architecture as we know it, globally, may be upset by default by one of these governments. For some of you who have studied finance, you would know that we always maintained that governments do not default, but it's becoming clearer and clearer that the level of debt is going up, and at some point, governments are going to default. And therefore, we need to be very conservative in the way that we manage our own personal finances, get rid of debt, maintain sufficient buffers. If you do not have, buffers, do not have this view that there is something called a guaranteed returns. I think the era of guaranteeing returns, has gone, away, just because of the uncertainty, that we are seeing globally. And what is driving most of that uncertainty is this geopolitical, risk that we are seeing, where countries are, at conflict, with each other. So get rid of debt, get rid of debt. Trust me, you will remember me one day when interest rates, rise to a level that you cannot, sustain. Maintain buffers. By a buffer, we're talking about that emergency fund that we've always been talking about. It's a conservative way of managing, your finances. There are risks out there. The world as we know it financially, we don't know when it's going to happen, but that financial architecture will need to reset at some point, because there is no way that the United States government can still be called a AAA economy while they continue borrowing and borrowing and borrowing. The other thing that I would want to say, Tafadzwa, I know I'm saying quite a lot. What I have learned from the United States and from, even I've given an example of an African country that is trying to resolve its debt problems. Debt can be a drug that we can be addicted to. And it happens even to the best of all people, where you actually build your asset base based on a house of cards. If you are building your lifestyle on debt, it's like somebody who is building a house of cards. Eventually, that house of cards will collapse. And that's what we're beginning to learn. And that's a source of concern, to me. I can tell you now, militaries of countries around the world are investing into technology, because the only reason why they are doing so is that the only way you can resolve, these issues is through fighting. Because look, it's unsustainable, some of the debt burden that I'm seeing in economies. At a personal level, let debt not become a drag in the way that you manage your personal finance. Stay away from unproductive debt. That's all I have to say, Tafadzwa, for the time being.
Thank you very much for reminding us to stay away from debt, and also just highlighting that debt is like a drug. It actually can be addictive. So yeah, you have launched financial education sessions. Can you talk about, give us some more information?
Tafadzwa, I've projected something on the screen. I hope our viewers can actually see it. We've actually designed a curriculum So every Saturday at 2 p.m., we will be taking those that are willing to invest in such a program through various topics. So it's a 10-module program, and the first group has already started in February. That was the inaugural group that we have, and we've done 4 lessons already. We'll be having another intake in March. So how much does it cost? It costs 300 rands per lesson. So the whole package of 10 modules will cost 3,000 rands, just for those that are interested. So we first talk about how to embed the correct beliefs about money, because there is no way that you can manage money if you don't have the correct beliefs. We believe that it starts with the mindset. Then we talk about basic financial management numbers. Then in module 3, we teach people how to budget the right way, how to get out of debt. That's module 4. Module 5 is how to build these buffers that I was talking about. How do you save for a rainy day? Because that rainy day is coming. Module 6 is about how to manage your insurance and to manage your risk. I always tell people insurance is very necessary, but you mustn't be over-insured. Module 7 is about building effective negotiation skills. Module 8 is about managing your tax liabilities. Module 9 is about investing. And then we crown everything with module 10, which is all about how to craft this 5-year financial independence plan. If you would want to be part of our March intake, these lessons happen every Saturday. So every Saturday, over a 1.5-hour period, we cover a module each. So just send an email to thembaduplex.mazibuko@gmail.com, and then somebody will respond to your email. So back to you, Tafadzo.
Thank you very much for that information. I also just wanted to find out, maybe if someone wants to be coached, not necessarily in a group setup, do you have such a program? Maybe someone wants to be helped to manage their investments, but on a personal level.
Yes, we do. So they would need to send the same, send the message to the same email. What I have just presented is what we call a group coaching session. So I'm coaching a group of people. So that is much more manageable to in terms of cost. One-on-one coaching is much more expensive. So if group coaching is about 300, one-on-one coaching would be 10 times that. So that's the costing, Tafadzo.
Okay, I'm sure we have heard that. If you want one-on-one coaching, maybe if you want to ask more questions or to show some figures, it's 3,000 rands per session. Is it per session or per month?
It's per session.
Per session. Okay, so 3,000 rands per session if you want a one-on-one, and 300 rands per session if you want a group session. Okay, I'm sure we will also remind people at the end of the show. Yes, today we're talking about investments. What is an investment?
Thank you for that, Tafadzo. So the topic for today is how to construct an investment portfolio. Before I go into that subject, maybe we may need to define those terms so that our audience do not lose us along the journey. So what is an investment? An investment is what we've been calling an asset class. So you actually commit on a monthly basis a sum of money where you invest in an asset class. So an example of an asset class could be a share. So that would be stocks. It could be a bond, which is the government borrowing that I've been talking about. It could be what we spoke about the other time, Tafadzo, when we were talking about index funds and EFTs. So that's an example of an asset class, there. And even cash itself is a type of an asset class. So an investment, the thing about an investment is that you are investing in an asset class, but you are doing so with an objective. You're not just investing in an asset class. And I need to emphasize this. I think, to me, some of the things that qualify you to be an investor is, number one, your investment goals. So the objective in investing is always to beat inflation. It's always to beat certain benchmark indices, so that you can have an adequate return. And that adequate return is mostly a function of your risk appetite. In finance, we've got the equivalent of the law of gravity, which basically says high risk, high return. And what it basically means is that your return is linked to your appetite for risk. If you want to increase your return, you assume more risk. So an investment is basically an asset class that you have invested in consistently. What distinguishes somebody, what characterizes somebody to be an investor? I think it's having an investment objective. I see people committing money, but they don't have an investment objective. But secondly, for you to be an investor, I think it's also a function of time horizon. The way we present the course on investing is that we distinguish between, number one, investing and speculation. In my view, if you are investing because you want to get your money or you want to have the return in a year's time, that time horizon is too short for you to have profited from the investment. So real investors like Warren Buffett, intelligent investors like the one that Benjamin Graham envisaged, have got a longer time horizon. So I always say to people, if your time horizon is less than 5 years, you are not an investor. You are a speculator. You want to profit from short-term movements in asset, prices. And one of the things that we've been encouraging our audience to do is to have a longer, time horizon as far as investments are concerned. And some of the objectives that you would have, would be, building an asset base for retirement, because you want to retire at a particular, age, or in 5 years, probably, if you are a parent, you want to invest funds into a college fund so that when your kids get to college, they have got, money that has been invested on their behalf, and you will not struggle taking your children through, university. What I find among some of the people that we coach is that our time horizons are too short. Sometimes we don't have this long-term, mentality. I don't want to repeat the story again, Tafadzwa, but the last time we were talking about the Warren Buffett mentality, where he's able to put money to work on his behalf, and for long times or periods, so that the laws of compound interest can work on his behalf. And that's essentially what investment is all about. We also need to, so I've distinguished between investment and speculation. And the way I've distinguished between the two is through the time horizon. Investors have got a longer time horizon. Speculators have got a very short time horizon. And in my view, anything less than 5 years is speculation. Anything more than 5 years is real investing. We also need to distinguish between investing and saving. Most of the people that follow us are savers. So probably you are single, you want to save for your wedding because you think your wedding will happen in a year's time. And then you put money in a bank account. When you do that, you are not investing. You are actually saving. Savers are trying to accumulate a sum of money because they want to meet certain expenses, normally in the short term. The thing about savers is that rarely do they beat inflation. You're not going to beat inflation by putting your money in a bank account. You're going to beat inflation when you research about certain asset classes, invest your money in those asset classes, with a long-term, horizon. So that's what an investment, is. We've been quoting Benjamin Graham, today. Let me just take a quote from The Intelligent Investor. There is a sentence that he writes there where he says, an investment operation is one which, upon thorough analysis, promises safety of principle and an adequate, return. Operations not meeting these requirements are speculative. So what is Benjamin Graham, saying? Benjamin Graham always believed in a thorough analysis. When he talks about thorough analysis, he's talking about researching the investment. So remember, Benjamin Graham existed in the 1920s. For some of you who might have an idea of financial history, you know that in the 1920s, there was what is called the great, stock market crash. So stock prices crashed. And Benjamin Graham was one of those people who studied that stock market crash and tried to come up with a framework that people could follow if they wanted to invest in the stock market with, some assurance of safety. So one of the laws that even Warren Buffett follows himself is that when you are investing, you do not lose your capital or your principal. So investing is very different from speculation. Investing is a very safe thing. You invest in something that you actually know how the income will be generated. We're not talking about pyramid schemes. So some people may sell you a pyramid scheme. They sell you promises of high returns. But even as an individual, you don't even know how the money will be made. That's speculation. Sometimes we tell people if it is too good to be true, it probably is. When we talk about investing, it's totally different. We're talking about thorough analysis. We're talking about, obviously you can't guarantee, remember what I said earlier on, you can't guarantee that there won't be any losses. But because we have researched about that particular investment, you've got, some kind of, safety in terms of the, the invested capital, and you are aiming for an adequate, returns. If you don't follow this principle, that Benjamin Graham, Warren Buffett they've established, you are probably speculating. You're probably, speculating. So maybe let me answer the other question that you have asked, Tafadzo. What is an investment portfolio? An investment portfolio is then a collection of investments that you have chosen in your portfolio in order to meet specific goals. I need to emphasize something which is very important. Remember, I said investors have got objectives or goals, and those goals are clearly articulated. So don't go around, and this is a very important point that I'm about to make, Tafadzo. I see people who just want to buy this financial product and that financial product. Before you start investing in financial products, make sure you have written your objectives down and you've got a plan first. So what comes first is the plan. Then whatever you do in terms of investing in certain assets or buying certain financial products, it has to be aligned with your plan. So if you don't have an investment objective, you don't have a plan, you are not an investor, and you are probably not going to make progress and even to achieve what you have set yourself, to achieve. So when we are building a portfolio of assets, we are actually choosing certain assets that will help us to meet our investment, goals. And those investment goals, in most cases could be to save for retirement, to create a passive stream of income, to reach financial independence, or something like that. We have taught people that it's possible to retire in 5 years, as long as you've got a stream of income. And what we coach people to do is to manage that stream of income in such a way that you can, retire at the end of 5 years. For you to be able to achieve that, you need to have this skill of building the portfolio of assets, which will then constitute your asset base, from which you are going to generate a passive stream of income. Portfolio construction is a skill on its own. It's not something that should happen by accident. And once Tafadzo gives me the green light, I will take you through some certain steps that you then follow to put together that particular, portfolio. Back to you, Tafadzo.
Thank you very much for highlighting that constructing an investment portfolio is actually a skill. I think it's one thing that has really challenged me as an investor. Maybe I'm a risk-averse investor, so I'm careful where my cents go to. So yes, how do we construct? You've just said now you take us through the steps.
So Tafadzo, I want to take our audience through 6 steps of constructing this investment portfolio. But before I do that, let's just refresh on some of the principles that we've been highlighting throughout these particular coaching sessions. So the first thing that I would want to highlight, which is a principle that Benjamin Graham, that Warren Buffett, who are gurus in this field of investment, have established. So the first principle that I would want to highlight is that overall, a well-diversified portfolio is your best bet, for a consistent long-term growth of your investments. So when we are constructing an investment portfolio, we are also trying to diversify, the risk. We don't want to put our eggs in one basket, so to speak. That's one of the things that I would want our audience, to really, understand. Occasionally, you're going to hear stories of somebody who invested in a particular stock, and that stock went up, significantly, and they made lots of money. You're going to hear stories of people that invested in cryptocurrencies, and the price of cryptocurrencies went up significantly, and they made lots of money. Now, my intention is not necessarily to rubbish such stories. Those things do happen, but yes, they happen. But what we are saying today is that it's now been established in finance that a well-diversified portfolio is your best bet if you've got an objective to achieve long-term growth of your portfolio. I've spoken about geopolitical risk. Have you realized that sometimes you can choose the best stocks there are to choose, but then because of the uncertainty in the environment, stock prices can plunge. You have got no guarantee that stock prices will continue going up and going up. So for us to manage that risk, we have to create and to construct a well-diversified portfolio. So that's the first principle that I would want to really establish. The second principle that I would want to establish, which I have already spoken about, is that investment is not like just choosing to invest in a particular share at random. In other words, you just think, maybe Anglo-American would be the best share to invest in. Investors do their own research, and I need for us to understand that investors do research, and the kind of investment that I'm a fan of is something that will be called fundamental investing, where you invest based on fundamentals of the asset base that you would want to invest. In other words, you research thoroughly about that particular investment. You understand its risk characteristics. You do quite a lot of due diligence, based on the information, that you have, and then you invest. So we're trying to create a diversified portfolio. But when we invest, we also take the trouble. You cannot be an investor if you don't understand certain numbers. You know, in the coaching that we do, we coach people on certain numbers such as inflation. You need to understand inflation. You need to understand interest rates. You need to understand tax rates. In fact, those three numbers are very important. You need to have a general appreciation of business models and a general appreciation of financial statements. You don't have to be a guru in it, but you just have to have an appreciation of those things, which is very important. The third thing that I would want to say before I go into the steps of constructing an investment portfolio is that most of the people that go into the stock market actually don't know what they are doing. They don't know what they are doing. So they tend to follow each other like a herd of cattle. So that's why we are using the term an intelligent investor. It's a borrowed term. We're not the originators of that term. There is a book that was written by Benjamin Graham called The Intelligent Investor. So if you look at investors, some, just like we have a parable, Tafadzo, in the Bible, we've got a parable of the wise and the foolish virgins. The same parable can be used in the world of investing. We've got intelligent investors and very foolish investors. Now, the foolish investors tend to lose money, and the intelligent investors gain in terms of their investment. So not everyone who is investing is actually an intelligent investor. That's why your quote is very important, Tafadzo, what you quoted at the beginning of this presentation. You basically said investors are realists, and as realists, they sell to the pessimists and they buy, and they sell to the optimists and they buy from the pessimists. That's the long and short of investment, investing, as Benjamin Graham, put it. Warren Buffett put it slightly differently. He believes in buying undervalued shares and selling overvalued shares. In other words, when Warren Buffett invests, he does not necessarily look at the stock price of the share. He's got his own price that he calculates through research. If he sees that the market is undervaluing the share, he then invests in that particular share, knowing that over time, the real price will actually correct and go up to what the value of the share is actually. By the way, let me just tell a story. And this story, again, is happening from a long time ago. Some of you might know Sir Isaac Newton. We quoted Sir Isaac Newton. I'm talking about Sir Isaac Newton, the physicist. We quoted Sir Isaac Newton in our last presentation, Tafadzo, where Sir Isaac Newton said that compound interest is the eighth wonder of the world. Sir Isaac Newton, for your own information, as intelligent as he was also an investor. So he invested in a particular company called the South Sea Company years ago. And when he invested in that company called the South Sea Company, because of the speculation that was happening during that time, the price of the South Sea Company went up quite significantly. And when it went up quite significantly, Sir Isaac Newton did a very wise thing. He actually sold his share, and they made a huge profit, out of that. Before he made that huge profit, he made a very significant statement, which I would want to quote to our audience. He said, as a physicist, I can calculate how planets move using the laws of physics, but I can never calculate the foolishness that people have when it comes to investing. And the reason why he was saying that is that there is something that we call behavioral economics in the world of finance. And this is this phenomenon that says that sometimes people do not act rationally when it comes to money. So what was happening during that time is that there was quite a lot of speculative behavior where people were buying shares of the South Sea Company, and then it started going up. And that price, was not supported by fundamentals of the company. And then the second part of the story is when Sir Isaac Newton watched, the South Sea Company rise in price, he then decided to buy the share of the South Sea Company. So he bought, right after buying that share, the price of the South Sea Company collapsed and he lost something like, 20,000 pounds. So what I'm just trying to say is that Sir Isaac Newton was a very clever person. But when it comes to markets, sometimes people don't act rationally. Within the markets that we invest in, there are foolish people who tend to move together like a head of, cattle. So if you want to be a wise and an intelligent investor, you need to have a plan, an objective, and to stick to certain well-established and proven investment principles. And these are the principles that we are sharing with you, today. Principles such as diversification, principles such as understanding what you are investing in, principles such as understanding that the time to invest is when people are generally pessimistic, and the time to sell is when people are generally optimistic. And so once you understand those fundamentals, you are likely, going to be a great investor. Your level of education does not qualify you to be the best investor. Sir Isaac Newton was a very wise man, intelligent man, but he lost a lot of money because of the speculative behavior. And, we've seen wise people, very wise people lose money. I know I'm doing quite a lot of storytelling, but I thought the story of Sir Isaac Newton would really help our audience. Let's now talk about how to construct an investment portfolio. So number one, we've already spoken about this. You need to determine your investment goals. Are you putting this investment portfolio because you want to save for retirement? Are you putting this investment portfolio because you want to create a stream of passive income? Your goals need to be clarified. What is your investment horizon? That's why we believe in a 5-year plan. We believe that you can put in place a plan which after 5 years would take you to where you would want to go. My goal when I started investing at a very young age was to retire very early. And when you've got such a plan, it then determines what you are going to buy and to put in your investment portfolio. I'll be very honest with our audience today. When I started working, because I had an objective to retire early, I never really bought some of the financial products that insurance people were selling. They will sell you retirement annuities and all of it. I told them, look, I don't intend to retire at the age of 65. And so any product that will cause me to retire at the age of 65 is not for me. The reason I could say that is because I had my own investment goals, which were very, very clear. So you must have your own investment goals, which are clear. At the time of goal setting, you haven't chosen any stock. You haven't chosen any asset base to invest in. You're just coming up with a plan. Secondly, you need to determine your risk appetite. I heard Utafats was saying that you are risk averse. That's your appetite. Nothing wrong with that. For the benefit of our audience, people who are risk averse are generally people who avoid risk. So Tafatswa is risk averse. I am a risk-taking person. So I actually look for risk. So you'll actually see that we are different. We are wired differently. So when we talk about your risk appetite, we're talking about how your wiring for risk is like. Some people are risk averse, others are risk neutral, and then there is a group of people that like taking risks. You look at a person such as Elon Musk. Elon Musk is a risk taker. And so people are different. you need to know your risk appetite. Risk appetite is a function of your wiring, but sometimes it's a function of your age as well. When you are young, you can afford to lose, money. And therefore, at that stage of your life, you can take more risk. When you are nearing retirement, you can't afford to lose money. And therefore, your risk appetite is low. So to some extent, your risk appetite is linked to your age, as well. But one of the things that I believe in very well is that your risk appetite is a level of your education for the most part. The more educated you are, the more you can actually determine what risk, to take. But it's very important to determine your risk appetite. So you've got an investment goal, you determine your risk appetite. From step 3 up to step 6, you are trying to maximize your return for the level of risk that you have. Number 3, you need to determine the appropriate asset allocation for your investment goals and risk tolerance. So what is asset allocation? Asset allocation is basically the percentages that you are going to allocate to each asset type. So let's look at various asset types. Stocks are an example of an investment class or an asset class. Bonds are another example. Then we can talk about even property, another example of an asset class. We can also talk about cash. Cryptocurrency is an example of an asset class, as well. Even gold. Gold is an example of an asset class. So what you then need to do is then to determine, you now know your goals. You now know your risk appetite. If your risk appetite is low, you are going to have a greater weighting to asset classes such as bonds, because bonds is generally very safe investments that generate a consistent, cash flow over time. Stocks are more riskier, and there are certain, type of stocks which have got more risk than others. Later on, I will go into different types of stock investment. There are things that we call growth stocks, for example. So there are different types of shares, and each of those shares have got their own, risk profile. An investment such as a cryptocurrency investment is a high risk investment. Gold is generally a safe investment. So the wisdom has always been, you must have all these assets in your portfolio. So you need a mix of these assets in your portfolio. You need some kind of gold. Why do you need gold? You need gold because there are times when the world seems to be falling apart. And in those times, people return to what are called safe haven assets. And gold is an example of a safe haven assets. And gold has even done, very well. The wisdom has always been, you must not have more than 5% of your asset allocation to these safe haven, assets, such as gold. But you need some level of exposure to those kinds of assets. One of the things that I've been thinking about over the past few months is, where do I put an asset class such as cryptocurrency? For example, there are people who are of the view that, if you look at crypto as an asset class, that is, if you believe that it's an investment class, probably, because of the nature of that asset class, it will replace probably gold as a safe haven, assets. If you take that view, then probably your level of exposure, your asset allocation to cryptocurrencies would be, in the region of, 5%. Then you also need a level of exposure to shares. This is where your risk appetite comes in. So if you're the risk-taking person, you probably need, 40% exposure, to shares. You need, a level of exposure to bonds, as well. Because, if you think about treasuries, for example, treasuries is how governments borrow money. they actually issue this instrument called, a treasury bill or a government bond, and that's their way from, of borrowing from the market. So, in South Africa, we've had these, securities that have been issued within the treasury environment, and some of them are actually quite attractive from a tax point of view. The thing about investing in some of these assets is, if, because with treasuries, the risk is, is very low. And also some of the assets that have been issued by, South African Treasury Department are actually tax efficient. And some people are including, those as part of their, of their portfolio as well. So that has been the general wisdom around asset allocation. How have I done it myself? In my portfolio, I've got, 3 types of assets. So I do, some asset allocation, but because I have acquired knowledge over time, and because I understand finances, and because my goal is to retire early, I am quite aggressive in the way I invest. So I invest in sometimes, not only plain vanilla products, but some products that have got a huge, risk. So in my portfolio, number one, I founded a business, probably the largest, allocation of my, investment is in my own business, right? And that has grown. I've been able to beat even the stock market and beat every other investment because I'm an insider. And one of the things that you learn about investing is that the more information, the more inside information you've got, the more controls you have as an investor. One of the reasons why people lose money is because you're trying to invest into what somebody has already done, and therefore you are an outsider. And there are always people who are insiders. And one of the reasons why I like my own business is because I'm an insider. And therefore, I can actually influence my own investment. Apart from my own business, I invest in property. And, property is your first entry, probably for most of us, into the world of investing. And I've always encouraged professionals to invest in property, right? I also invest in shares. So, those are the, the major asset allocations that I have done. I used to have a cryptocurrency portfolio, but in this year, not doing anything on cryptocurrencies, I lost a lot of money. My whole portfolio last year increased quite substantially. But if I look at the cryptocurrency, so I leave those things about crypto to my own sons. They are also into investing. They love things about crypto. So we argue quite a lot in our home about the general direction of cryptocurrency. But the advice that we dispense on this show is that stay away from cryptocurrency, particularly in this year. Stay away. Cryptocurrency it's a technology for the future. But to make money out of it, I think there's going to be a lot of volatility. So stay away. So now you've determined your investment goals. You have set your risk. You understood your risk appetite. You have made certain asset allocations. And those asset allocations are informed by your investment goals and your risk tolerances. You then begin to pick individual assets. So when you pick assets into your portfolio, you are picking assets based on an investment philosophy. I always advise people to have an investment philosophy. And my philosophy of investing is informed by Warren Buffett and what he says. And so when I pick, stocks into my portfolio, particularly for the share portfolio that I have, I'm buying undervalued shares. I've modified to some extent, and I share this with my close group of people whom I coach. I've modified the Warren Buffett approach, but my approach is essentially based on Warren Buffett. I don't buy shares to sell. I buy to hold. And as long as that share price is performing, is going up, I hold it in my portfolio. But I buy undervalued shares. So I do my own research, and I buy shares that generate a lot of income with solid management teams. They've got a solid business model. and they are likely going to grow, over time. So you then pick individual assets into your portfolio. You're not picking those assets at random. The picking of assets is informed by your philosophy. And my advice is to adopt philosophies of people who have measured in investment. Number 5, you then monitor the diversification of your portfolio, checking to see how the weightings have changed, over time. And then you make an adjustment. So over time, you can then make adjustments. In our last presentation, we spoke about index funds. We spoke about EFTs. Those kinds of investments are very good, particularly for people that are risk averse, people that do not have the time to do research, as far as investing is concerned. My advice is that at the beginning of each year, you then look at your portfolio and see how it's doing and making certain adjustments as necessary. Let me make one more point before I hand over to you, Tafadzwa. And this is a simple point. I know those that have been following us on this show all understand this point already. When we look at your assets that you have, not every asset qualifies to be an investment, right? Let me make it that clear. So think of something like, how it is. Let me give you an example of a car. We buy cars, for practical purposes to move from one place to another. A car is not an investment. So it's not part of your investment portfolio. You don't include a car and say the car that I have bought is part of my investment portfolio. Those are not the assets that we are talking about. So that's why when you want to be an intelligent investor, you're not going to buy the most expensive car in the whole world, particularly if you are going to finance it using debt. That's being a foolish person. And I'll just say it as plainly as I can say it, because it's all coming from a heart that wants to help people. So a car, we're not including cars in your investment portfolio because there is no cash flow associated with the car. Investments have got a cash flow associated to them, with them. They generate cash flows. They grow in value in the future. The furniture that you have in the home is not an investment, right? So we're not including the furniture that you have, the car that you have. Probably the only time we start including things in this portfolio is the house that you live in, because there is every likelihood that that house will start appreciating in value. So I thought I should just mention that particular point. Then there is always the debate around, there are these people that buy rare paintings. They buy, and I know I've come across people who buy expensive watches. They buy exotic, cars. Cars from the other generation. There are people who invest in those things. So the question then becomes, if Themba had said a car is not an investment, what about those cars, those old cars from the other generation? I'm sure you know the cars that I'm talking about, or the paintings that were done by all these famous painters like the Mona Lisa, painting. So the question has always been asked, is that an investment? Strictly, according to the Benjamin Graham and Warren Buffett definition, those kinds of things are not investments. Why? Because there is no cash flow associated with them, right? You can buy a rare painting with the hope that its price will appreciate. Once you start having this view that says, I hope the price of the painting will appreciate in the future. Once you have that hope, just know that you are entering the world of speculation. You have moved from the world of investing, because in the world of investing, it's mostly about cash flow. Cash is king. If you've got something that you are calling an asset, and that thing does not generate cash, it's not an investment. Yes, there are people who have made money from rare paintings, from exotic things, cars from the other generation, and all of those things. You can make money that way, but it doesn't meet the strict definition of an investment, right? If you understand, because the reason why it doesn't meet the strict definition of investment is that you are relying in the future on somebody who is more foolish than you to buy that rare painting from you. What if that person does not come your way? What will happen to that painting? So although I've said that, there could be an instance where rare paintings and all of these cars can become an investment, particularly where there's been a market, right? A market that establishes a price for them, and in that market there is a willing buyer, willing seller. So even in the world of paintings, there's been established a market where you can go sell your painting, and there are people who can authenticate these paintings. And even in the world of cars, those vintage cars, it's possible that there is a market. Once you've got a market and people who formalize, then we are talking about an investment, in that. But if you don't have a market and it's all speculative behavior that you are engaging in, please stay away from speculation. Just stay away from speculation. Stay away from investments that are shrouded in secrecy, where people tell you, you are the only one, that if you invest in this thing, you can benefit. Just stay away from anything that is shrouded in secrecy. Something that you don't know whether there are products being sold and what kind of products are being sold and that kind of thing. Tafadzo, I've spent quite a lot of time, and probably we've reached the end of this workshop. So let me just stop there. Probably what we can do is just to take any questions from our viewers or those that are listening to us, and then we can then stop, from there.
Thank you very much for that insightful information. Munyaradzi is asking, how do you invest in your business? How do you get your returns? Do you own the business alone? Is that how you have control? Or should I ask them one by one, or it's fine?
No. I think I get where Munyaradzi is going. Munyaradzi, we have a session in the future where we address this particular, question. But let me just say something which may upset, many people. There are people who think that they have got a business, but that they don't actually have a business. The way we define a business is something that you are going to sell in the future to somebody. There are certain businesses that will never be sold to anybody because you are the person who is running that particular business and everything revolves around you. So let's just say things plainly. If you don't have employees in your business, you don't have a business. You are probably self-employed, right? You're probably self-employed. There are people that leave their jobs and then they employ themselves. Being self-employed is not a business. You are in business, but that's not the kind of business that we are talking about. When we are talking about a business, we are talking about an asset of value that somebody can be willing to invest in. As long as you've got an enterprise which somebody is not willing to buy from you, you do not have a business, right? Let's just be clear. And the general guidelines are that you need to be employing people. You need to have a product or a service that the market desires. And you need not necessarily to be involved in your business. Once you are an entrepreneur who is too involved in their business, so we always say this thing, and this is advice that I got from one billionaire. He said, Themba, don't work in your business, work on your business. Right? Don't work in your business. Many people are working in their business. They are not working on their business. When you're trying to create an asset of value over time, you are not so much consumed about working in your business, because if you work on your business, you are the business, and therefore nobody can buy you. But you're trying to create an asset of value. And this asset of value, can be able to function even without you, because you have raised people to work in your business, and all you're doing is having controls to increase the value of your investments. All right. That's why you see founders, they start working in their business, then they quickly move on to CEO, then they move on to executive chairperson, then they employ a CEO to run the business. There is another billionaire that I like very well, and he has been a role model in my life. His name is Themba Mazibuko. I've studied that man. I like the way he has done things. He's originally from Zimbabwe. And if you look at the way that he built his business, he built his business, employed people, left it to run, in Zimbabwe, went to establish other business. That's what we call working on your business. If he had continued, working in his business, there is no way he could have grown that investment, over time. So work on your business, not in your business. But we will have time, Tafadzwa, to look into the questions that Munyaradzi has raised, and we've got a special session that is dedicated to that particular point. But that's what I want to say, at least for the time being.
Thank you for that response. I hope Munyaradzi found it helpful. We also got another question. What would be your advice for someone who is living from paycheck to paycheck and they want to invest, but at the end of the month, the money is allocated to fees, rent, and there's nothing, but they also want to grow their wealth and invest?
There are two pieces of advice that I have. The first piece of advice is downgrade. Tafadzwa, we've been married for a long time. You know how much we've downgraded, in our lives. Don't let circumstances on your life force you to downgrade. If you are living from paycheck to paycheck, the first piece of advice that I have is, to the extent possible, downgrade. It's possible. Tafadzwa, when we started working, you would know our story. We were driving big cars. Then we downgraded. All right. That's a practical thing to do. The second thing that I would want to say to that person is that look at areas of generating other additional sources of income. I used to work for a bank, so I would go there from 8 to 5, I would be working there. And then after 5, I would be teaching people, right? Like I'm doing, right? And from that teaching, particularly over weekends, I was able to generate a source of income. We call those side hustles. So if you're living from paycheck to paycheck, it's not sustainable. The first thing that you need to do is to downgrade. If you can't downgrade significantly, find a side hustle to do. Something that you can do over the weekend. Tafadzwa, you would know our story. We tried to sell Herbalife over the weekends as a way of generating additional income. And those are viable things. I'm no longer doing network marketing, but network marketing taught me many skills. I learned to sell. And those are selling skills that I've even used in my business. I don't know, Tafadzwa, how many network marketing opportunities we're involved in. So network marketing is something that I would even advise to people, particularly if you've got selling skills and you are passionate about the product. So if you're living from paycheck to paycheck, create a side hustle, investigate things such as network marketing, because network marketing enables you to create leveraged income. So those are the two pieces of advice that I would want to give, Tafadzwa.
Thank you very much for that. I think we're coming to the end. What would be the closing remarks, maybe in 2 minutes?
Everyone must be an investor. Everyone must create passive income. The question was asked today, I'm living from paycheck to paycheck. we call that earned income. You must find a way of converting that earned income into passive income. And the only viable way to do that is through investing. So I encourage you, embark on this journey of being an investor. Have an investment objective, have a philosophy to invest, and you will do well, particularly in this uncertain world. Those would be my closing remarks, Tafadzo.
Thank you very much, Themba, and thank you everyone who has joined us, those who have asked questions, those who have commented. We really appreciate your participation. Thank you, Themba. Themba is a renowned speaker, so if you want a speaker at your conference to speak on the topic of finances, you can get hold of Themba, you can get hold of me, then I will communicate with Themba. You can, if you also want to join the sessions that he has mentioned earlier, the financial education sessions, which are held on Saturdays, you can write to Themba Mazibuko at gmail.com, or you can send us a WhatsApp or send an email to Tafazo at tafazomazibukospeaks.co.za, and we'll give you information. If you don't want to be part of a group and you want to do it individually, there are also sessions as indicated. It's more money, but maybe worth it if you want more detail or more attention and maybe some privacy to your finances. So if you write us an email or send us a WhatsApp, we'll give you more information. If you want to know more about us, you can also visit our website, www.tafazomazibukospeaks.co.za. Thank you, everyone, for joining us. Enjoy your weekend and cheers. Thanks.